The stock market went up today and it kept going. We really didn't see any major pullbacks intraday like we're used to seeing in 2022. And once we got to major resistance levels on the S&P 500, we blew past them and continued to rally, guys. So this right now is looking like we could be going into a massive short squeeze if the markets are right about the December Fed meeting. If Fed Powell confirms what we think coming next week on Wednesday, well, the move could be nothing short of parabolic. And exactly how I am positioning for that rally will be discussed to you guys here in this video, as well as the technicals, as well as the option activity from the hedge funds, what the experts are saying about this market. So let's get straight into all of that information. Hit the like button and subscribe to the channel if you guys have not already in the 30 seconds or so I have been talking, because it's free 99. So first things first, S&P 500 up 2.38% on the day, up $9.04, up an additional 0.28% in after hours. Typically, when you get a strong move like this, it's very common to see after hours down, but we're actually up another dollar in after hours, which is pretty atypical. It's not that typical to see it after such a strong day. And a big reason why you're seeing this momentum is on a technical basis. We'll talk about that in just 1 second, but you're also seeing really good earnings out of Apple, which definitely helped fuel a lot of this rally that we've seen today. Apple was up like 9% on the day, just absolutely insane. Let's go ahead and pull up exactly where Apple did close the day. Up 7.5% in regular trading, up 0.27% in after hours trading. So that is even continuing into the after hours, which is again a very positive thing. And Apple, like I said in the last video, was real with the markets. They said, hey, this next upcoming quarter is not looking so hot as of right now, kind of loosening those market expectations, right? So I think that was a positive thing for the markets. And I think the markets really do respect when Apple comes out and says that, and they're going to give them the benefit of the doubt, at least for now, until we get to that next earnings season or something changes. But the biggest thing of today was really the probability of a 75 basis point rate hike in December did finally go down, meaning the probability in the market's eyes for the swaps for that December meeting are now better for a 50 basis point rate hike rather than a 75 basis point rate hike, meaning the markets are expecting now a 50 basis point rate hike instead of the 75 basis points. And that is a very, very bullish thing, especially in this marketplace where the expectations for rate hikes have really only gone up. Like, we went from 325 basis point rate hikes in January. That was our expectation for the whole year. We quickly blew past that. We had one 25 basis point rate hike, a 50 basis point rate hike, and 3 back-to-back 75 basis point rate hikes. And the markets are still firmly expecting a 75 basis point rate hike coming next week. But what they are not expecting is a 75 basis point rate hike in December. And you guys can see right here, 51.4% chance of a 50 basis point rate hike and a 41.3% chance of a 75 basis point rate hike. Also pricing in a 7.3% chance of a 25 basis point rate hike. So it's clear after the earnings that we have been seeing and the data that we got today, which we'll talk about in just 1 second, the markets are feeling like the Fed might take their foot off the gas. And that means you want to own stocks. That means that all of the shorting that hedge funds have been doing this year could really blow up in a big way, and you could see a lot of covering in a very short amount of time. That's what brings us to be making this video. Now, some of the data that did come out today is pending home sales fell 10% in September, much worse than expected. And it says the key points: pending home sales suffered a worse decline than expected from August to September as mortgage rates surged. Economists had predicted a 4% drop. Sales were down 31% year over year, including or excluding April 2020 at the start of the COVID pandemic. The housing home sales index is at its lowest level since June 2010. So what this is doing is showing that the Fed is at least slowing down demand in real estate by a very, very big degree. And the real estate, like Fed Powell says, that needs a reset, that reset is likely going to come sooner rather than later. Although real estate does take a while to come down in price, it's almost a certainty at this level that will happen. Now, also, the markets are pretty excited about core PCE year over year as well. We were expecting to get a 5.2% reading, and we got a 5.1% reading. The month over month, so that was slightly better than expected. And the month over month PCE for the core was a 0.5% gain. That's exactly what we were expecting. So it's not like, the economists were wrong again. It's not like, this data came in bad. It actually came in pretty good relative to what it could have been. And that's also another reason why the probabilities for those smaller rate hikes did go up here today. And that is a big reason, again, why you are seeing this move in the stock market. And like I said, I personally don't think this move is over with. Because personally, I do think the Fed is going to signal that they are about to slow down the pace of rate increases. Maybe not do what the Bank of Canada just did October 26th and essentially hit the markets with a surprise smaller rate hike. They were expecting, the markets over in Canada were expecting a 75 basis point rate hike, and they only got a 50 basis point rate hike. I don't necessarily think that is coming next week, November 2nd. That is next Wednesday. If it did happen in America, that would be very, very bullish, and you probably see a 5% positive day on the indexes. Don't think it's going to happen, but I do think they will signal for December that smaller rate hikes are more likely as long as the data does support it. They're obviously not going to stop raising rates, but that is going to be a very, very bullish thing, that the pace of rate increases will stop. There's been a lot of calls on the Fed to really slow this down by the International Monetary Fund, the Bank of Japan, basically everywhere has called on the United States to stop raising rates, because what it does to emerging markets is much worse than it does to even the American markets, the actual American economy, or the American stock market. So there's a lot of pressure on the Fed to slow down before they go too aggressive and break something, if they have not done that already. Now, nonetheless, why do I think there would actually be a short squeeze? Because of this slowing down the pace of rate increases. And it's pretty simple to really understand, is that hedge fund long exposure is at a record low, meaning that for every $100 that hedge funds put into the markets, 60-70% of that $100, $60-70 is going into short positions. The rest is going into long positions. So there's not a lot of people or hedge funds that are positioned for a big upside move from here. After all, a lot of people have sold stocks a long time ago, and people really don't have that much exposure to any upside move from this point. A lot of people are shorting the markets even still, and that really puts hedge funds, more specifically the guys that really move the markets, in a very bad situation if the Fed does give us that dovish stance. And even if you watch CNBC or other financial media outlets, nobody is expecting the Fed as of right now, or virtually nobody is expecting the Fed to come out and say, we're going to slow down the pace of rate increases, but yet you're seeing it being priced into the markets over here on the Fed Rate Monitor tool. And by pricing into the markets, that basically means people are betting on what the Fed is going to do, right? The future swaps for the federal funds rate. That's what they are, and that's how you bet on it, and that's where you get these probabilities of a certain percentage point rate hikes. Nonetheless, let's take a look at the S&P 500 and the option activity that we did see on the day and what we've seen over the past week. Anything over 50% positive order value is going to be a good thing. And today you've seen about 2,600 orders totaling $646 million with a positive order value of 71% on the markets. This is even better than yesterday, where you had 4,800 orders on the S&P worth about $856 million, positive order value of 53%. And over the past week, you have seen 34,638 orders totaling $513 billion with a positive order value of 73%. If you go over here and you take a look at the S&P 500 more specifically on a technical basis, we broke out above the 50 and the 100-day moving averages today, and we closed well above the 100-day moving average, especially this move in after hours, well above the 100-day moving average, which sits at about $388. We are over $390 here currently in after hours. So about a $2 move above the 100-day moving average is a very, very good sign heading into next week, where the Fed will have their meeting on Wednesday. And from here, from my perspective, if the Fed really did slow down the pace of rate increases, I think the 200-day moving average would be no question in the cards, even potentially that same day. But you could probably go as high as 430 or even 440 on the S&P before you did get some real rejection. And why I say this is because when that CPI report showed inflation had went down in August, the markets rallied about 18.5% from the lows to the peak, and that was back here around 430, and you did find resistance around the 200-day moving average like clockwork and got rejected from those levels. And this time around, the 200-day moving average is a lot lower for a good reason. The markets have been trending to the downside, hitting new lows, but if we can break out above that, we have something that's fundamentally positive, like the Fed slowing down the pace of rate increases. You might see something along the same lines as you've seen today, where we just broke out above the 50 and the 200-day moving average in the same day. So I don't think we would get as much resistance around that level, and I think that would serve as a longer term level of support, because once you break above the 200-day moving average, that is really a change in trend, right? That's a big trend factor, and we have not been above the 200-day moving average since back here in April of 2022. And you know, based off of what happened with CPI, that's why we just never got back to the 200-day moving average. We fell, got back up here in August, and then got rejected, and we've been far from that ever since. So I think that is really on the cards, on the table, if the Fed does slow down the pace of rate increases. I think there's really no way that we would not at least go to the 200-day moving average, if not go higher. And that, to me, would mean a lot of sweet, sweet tendies. And my favorite way to trade this as of right now is with the TQQQ. It's like the NASDAQ on steroids, right? But I think the premiums and the risk to reward makes a lot of sense here. What I've currently been doing is buying the $30 calls for December 16th on the TQQQ, because if the Fed doesn't U-turn and the markets fall, well, hopefully your options don't lose as much value, because we're going to know that information by next Wednesday, and then you could, you know, position accordingly, take a small loss, or just sell out that position, whatever the case is. Position for it, hopefully without taking a massive, you know, weekly YOLO on that event. And the premiums kind of make sense to go out a little bit further. Even if you look back here, what happened in August TQQQ went as high as $39. That means if you bought the $30 calls for $50, if we seen a similar move to what we seen in August, that's a very big if, then those options would be valued at $900+ a piece. I like that risk to reward proposition of, if the Fed does slow down, you're probably going to make 2,000% or more on those options, or even, 1,000%. That would be solid as well. And you could get, a $2,000 position in TQQQ that, if you bought 40 of these options, or 30 of them, 40 of them for $2,000, I believe it's 40 of them for $2,000, and these options even were valued at $500 a piece. Even if we seen just a move to 405 or 410 on the S&P, then that trade would be worth about $20,000. If we seen a similar move or a bigger move than what we seen in August, which I think is very likely, and those options went to $1,000 a piece, you're gonna make 40 grand off of $2,000. And what's your max loss on that if the Fed does not indicate a pivot next week? Given how much time is left, till December 16th, I think your downside could be pretty limited with this trade, and that's specifically why I like the TQQQ and going to that December expiration. So there's pretty much that as far as the short squeeze is concerned on the markets. Let's go ahead and take a look at AMC stock and what happened today, because we closed unchanged on AMC, at least for regular trading. A 0% gain on the day. 0% gain, and nothing happened today. In after hours, you were up 0.61%, and I think for a lot of your total risk on stocks like AMC, like a lot of the stocks that were a lot of your momentum runners throughout 2021 and even early in 2022 at certain points, I think those ones, they're going to react once the Fed does something, once there is an actual reason for people to buy, low quality stocks again. That's when you're going to see the shorts really get squeezed out of their positions. That's when they're actually going to cover on their positions, and that's when you could see a major short squeeze for these individual names as well. But the main concept of this video is explaining how a market wide short squeeze could be coming, and that will obviously have big implications for AMC for a lot of the other runners, and would likely go through a short squeeze at the same time as well. Now, the estimated short interest of free float is sitting at about 19.92% for AMC stock here today. The free float out on loan sitting at about 34.64%. The shares out on loan at 178.53 million. Days to cover at 4.74. Cost to borrow at 18.86%, and 100% share utilization. As far as the live short interest, the cost to borrow max is sitting at 20.14%. Really unvolatile as of lately. This is showing that there's a lot of solid demand to sell AMC stock short, and given we're at a 20% short interest, I think there's no way, if the Fed pivoted and kind of slowed down the pace of rate increases, that you would not see a substantial move up in the share price of AMC. And given we're at these very, very low levels, I think the risk to reward as well on something like AMC makes a lot more sense. Now, the cost to borrow average is sitting at 14.11%, and the cost to borrow minimum is sitting at 0.35%. Now, if we look at the option activity, 6 orders totaling $118,500, positive order value of 60% here today. Yesterday, you had 100% positive order value with 3 orders totaling $95,000. So there hasn't been a lot of dollars heading into AMC options, but some of the options have been quite bullish, like these 750 calls that we talked about for November 4th for next Friday, and for November 18th that we talked about in the last video. They've been pretty bullish once they are actually here, but you're really seeing a lot of the shorting activity taking place still in AMC stock, and a lot of names like AMC, and that's going to happen likely until the Fed does slow down the pace of rate increases. And I honestly think there's probably a 75% chance in that range of the Fed indicating they will slow down the pace of rate increases. If they don't, then they know full well that they're going to cause a major recession, if not a depression, once we let all of it play out. So guys, that is pretty much going to be all for this video. Hit that like button and subscribe to the channel if you guys have not already. Thank you for watching. If you guys want to come trade with me live in real time, link down below in the description of this video as well. You guys enjoy the rest of your day. Have a cold one on me. I will see you in the next one.